Well, so it is or maybe is not just a Target problem. Consumer sentiment has been weakening broadly in May. Joining me here at Post 9 to discuss all that and what it means for markets, Charles Schwab, Senior Investment Strategist, Kevin Gordon. Kevin, good to see you.
Hey, nice to see you, Mike.
We've been living in the jaws of this divide between hard and soft data for a while right now. Yeah. Obviously, whether it's a Target issue or not, it seems like there's not quite enough consumer growth to go around for everybody at the moment. How do you think that proceeds from here?
Yeah, that's the tough part. Is that so far it's really this voluntary budget constraint on the part of the consumer because the labor market has held in and has been relatively healthy, year to date. So even within the retail space and consumer discretionary, I find it interesting, in this earnings season, there hasn't been this common thread as Courtney was just talking about. It's not as if the entire discretionary sector has been suffering because of anything tariff related or because of anything fear of tariff related. So there has been maybe more idiosyncratic risk for certain companies, and you can see it in the earnings transcript. So I think that's going to be a pretty dominant theme moving forward because certain companies had stronger or weaker footing going into this. I think that's probably going to continue to be a theme. And so far in the aggregate consumer sentiment data, especially if you look at the University of Michigan results that we got most recently for May, most of the weakness and most of the anxiety was tied more around inflation. That survey tends to be driven more about inflation, but even the labor components, they didn't materially weaken from the prior months. So I think it's a good sign in the sense that labor is still holding, but bad sign for the companies that do depend a little bit more on the discretionary spend.
Yeah, the perception of future labor prospects is one of the aspects of that Michigan survey. I mean, the way it matters most immediately to investors is what is it going to mean for overall earnings looking in the second half of the year, and just the general risk reward for stocks right now as they're getting pinched by this move higher in yields.
Yeah, I think, the move today is interesting, and I think it really speaks to the impact from the rate of change of yields versus just that drift higher, because yields were actually drifting higher this morning, even as the S&P and the NASDAQ and the NASDAQ 100 were also getting close to, to flat, even though, the advanced decline statistics were pretty brutal. But I think it speaks to when you got that 20-year auction result and it was pretty bad, then yields started to spike. That's when you got the big drawdown in equities, and we're still suffering from that, last I checked. So it speaks to me more, even if you zoom this out over the past few years, the 10-year yield is broadly unchanged over the past couple of years.
Sure.
Or even a couple
of years,
But if you take it back a couple of years, I mean, the S&P is up over the past couple of years. So if this was a yields level problem, that wouldn't be the case, where the S&P was up, yet the 10-year yield was the same as it was a couple of years ago. So I think, and the second part and the add-on to that is probably just the reasoning for it. It's the why behind the move in the 10-year. So if it's driven by inflation concerns that are tied to the budget deficit that are then tied to the potential path of the dollar, I think that's probably the case today. Then that's more of a worrisome.
Yeah, I always like to point out, look, it's at various times in the past few years, it seemed as if 4% was a scary level. You had to kind of test it, see if the economy hung in there. Markets made their peace with those levels. And then you have a stock market, which arguably coming into this week was probably going to be in search of an excuse to pull back a little bit. So is that all it is, or did the rally overshoot to the upside?
Well, that's the thing, is that right at this point, you had just gotten into a lot of the sentiment metrics we track on an aggregate composite basis, compiling both attitudinal and behavioral. A lot of those had gotten, deeply washed out, and then you launched right back into right near excessive optimism territory in a really short period of time. So this is literally just coming, and the downgrade for Moody's is just coming at a time when you were sort of looking for or waiting for that negative catalyst to jolt you in the other direction, and we got it almost at that perfect timing. So it's kind of a funny thing that happens with sentiment, but it does tend to be a pretty good contrarian tell. It's not a good market timing tool, but it lets you know at least when stocks become a little bit more vulnerable to any sort of negative catalyst. I would argue that we're sort of in that moment again right now.
Has the composition of the rally or any characteristics of the market kind of revealed themselves as, okay, this is a thematic thing that we should latch on to or fade?
I do think if you zoom out and at least take it year to date, because there were really two big phases of the drawdown. I mean, as you know, the first part was everything DeepSeek and AI CapEx related. Second part was obviously Liberation Day and tariff related. But if you go back to the beginning of the year and you look at least on an industry basis, so if you break it down one more level from a sector, from the 11 sectors in the S&P, there has still been weakness in textiles and houseware, home goods and things like air freight freight and logistics. So I do think that the story under the surface of the market and what is being told, not just at the headline level, but what is being told at the industry level, is consistent with where we are in terms of the potential trajectory of the economy. If you don't see tariff rates come down meaningfully, and if those aren't part of the negotiations and so-called deals with other countries, then I think there are more deleterious impacts for the economy down the road. But we're just at least now back to, or at least the market's back to, trying to price in what the effects are over time versus having to deal with that all-at-once Liberation Day announcement where it is, probably more of a pull forward at the time of the recession risk. Now you've pushed that out just a little bit.
Meanwhile, you're getting kind of fiscal expansion maybe with this budget at the same time. It's pushing yields to where they are. So it's tighter and looser at the same time.